Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching, and thank you for watching the channel. Today, this episode, we're going to look at Ford Motor Company and see what we think the value is, where we think it might go, and if it's a good investment or not. Now, at this channel, we look for 5 key attributes for all investing. It helps us separate speculation from investing. Right? We are cash flow investors. We're buying cash flow, and so we use cash flow to underpin the intrinsic value of all investments. And we look for 5 key attributes. We look for top-line revenue growth, earnings growth, as we define it by EBITDA. We look for free cash flow growth, which is the underpinning of valuation, strong balance sheet, meaning less than 3 times debt, and a well-priced stock based on an enterprise to EBITDA multiple. We want that to be relatively low. We look for those 5 key attributes, hold the stock over a long time. We estimate what we believe the IRR, that's the internal annualized rate of return, holding it over a 10-year will yield. We see if that's above market and look for the risk-adjusted return. We think that might do it, then it's a good investment. That's how we look at all securities, and Ford here is going to be no different. So let's go through it. I read through the 10K, and I have to say that I was incredibly confused. Quite honestly, I've read a lot of 10Ks. There's nothing like reading a business, a 10K, and being confused. You gotta wonder, really, what is management doing if they can't simply explain their business in a straightforward way? The way they have Ford Motor Company and Ford Credit, this SPE, this special purpose entity that Ford Motor Company lends money to and then borrows from, and also sells cars to and receives cash from. It's incredibly confusing. Who's selling what to whom, how revenue's booked. As an example, Ford Motor Credit, which is consolidated on the entire balance sheet, books interest as income on the leases and financial loans that they give to customers as well as their dealers. It is quite confusing. I'm going to try to go through it. This is my best guess. I'm no professional at Ford, but I'm going to go through it and tell you what I think. But if I can, reach out to Ford, get the accounting department to clean up the disclosure in here, make it a little simpler. It's not hard to write a 10K, and they do one heck of a job confusing people. And that for me is an issue just in considering if it's an investment right out of the gate. If I can't clearly understand the business and the drivers, reading this thing, why should I put money in it? But let's go through it. So the first thing I want to talk to you about is how they sell their cars, right? So I'll zoom in here, and you can see 2019, this is dealerships in total. They have roughly 11,000 dealerships that they sell Ford and Lincoln through. I went back prior to the economic decline in 2008. So back almost 13 years to see what their dealers were at that time prior to the real estate collapse and the automotive bailout back then. They had roughly 19,000 dealerships at that time. So they have 11,000 dealerships now. So the business is shrinking in size over that period of time. And I don't know if the future is going to be much brighter for that. That's definitely a hard transition to or hard trend to transition away from. But let's keep going. In here, the first several pages, they kind of go through their business model, what they do, how they make it. This section here, I liked. It really showed you where their economic drivers are, the revenue of vehicles or vehicle sales. And you'll see that they are dominated by the trucks. 51% of sales for them is the truck. I think 34% was the SUV, and only 15% are cars, which surprised me. But I guess when I think about it, when I think of what I see driving around the street that has a Ford on it, it's typically the F-150 and then the Explorer. So that means pickup trucks and SUVs. But that's going to be an interesting. So in 2019, U.S. sales 1.2 million. I believe this is units. It's units of automobiles. So as this world transitions to an electric fleet, Ford kind of has a double-edged sword here. One, they have to create an electric fleet and sell it, but then two, that fleet is going to cannibalize existing sales as F-150 fans go from the gasoline F-150 to the electric F-150. That's logical. But then Ford has to sell on top of that to grow this number, to grow revenue, to grow earnings. So it's not just a case of can Ford electrify their automobile collection. It's really, can they electrify and gain market share? It's kind of two objectives that they need to do. But let's keep going. Here's the Ford segmentation. So they talk about their mobility segment, right? The mobility segment is the autonomous vehicle, EV stuff. That's burning about $1 billion a year. They just up the spending on it. And you can see that in the EBIT when they break out by segment. But they also talk about the Ford credit business here. And I definitely encourage you to read that. It's really, frankly, rather confusing. But what I did learn is they're not just financing vehicles. I looked at it and initially said, oh, okay, it's just the fleet financing. No, actually, Ford Credit also finances their dealerships for new dealers to acquire dealerships, for dealerships to expand. They finance working capital for dealerships. They make unsecured loans to dealers. So when you look at the debt on the books for Ford and it says, Ford Credit debt, that's not just attached to cars. Some of it is asset-backed, but a lot of it is unasset-backed, unsecured liabilities, which is a real problem. And you can't just think that if they have problems, you can take the car as a collateral, because there's dealerships, there's other working capital that has no collateral at all. So I think that was a big red flag for me in reading this, and we're going to go through the numbers and see how it stacks up. But I wanted to point out this section in particular, and I think you should read it. Okay. Let's go through the numbers and start picking apart Ford and see what we think on valuation, and we can come back and forth to some of the financials as we need. Behind me is 9 years of revenue for Ford. 2011, $135 billion, which is a lot of jack for a car company. Totally agree with you. And then they grew that to $155 billion over the 9-year period of time, which annualizes a 2% return, which is barely above inflation. I think most recent Fed announcement I have heard is that they are actually pushing inflation north of 2%. So in reality, in terms of real terms, forget nominal for a second, just real terms, it's zero growth. On nominal basis, it's growing at 2%, which barely meets our criteria for top-line revenue growth. EBITDA is negative over that time frame, with the caveat last year is $11 billion, and there's about $5 billion of issues with that number. Firsthand, they made a $2 billion global investment to upgrade their dealership network globally. It was $2 billion, so that's off that number. That I have not added it back. And then there's another $2 billion for a pension adjustment. It looks like their pension liability had grown too large. Auditors said, hey, you have to true that up. So they put cash towards the pension. It was $2 billion. So they've got $11 billion here. Realistically, it's somewhat flat. It grew a little bit in 27 and kind of a peak at 17, but largely hasn't done much throughout the year, which is, I guess, no surprise if dealerships have been coming down, revenue's kind of flat. They're making investments in mobility. The mobility is expensed in this line item. Remember, there's another $1 billion there that's in development. So EBITDA is flat. I don't expect it to grow anytime soon, given the investments that they need to make. So the EBITDA is flat. That's not going to check a box for us. Let's look at enterprise value and debt level and see where it stacks up. So here is the debt. Now I'm going to give you a stack up of the debt so you can see how I've pulled it. And let's actually go to the P&L and the balance sheet so you can see where I'm getting this from. This was pretty confusing. It's my best guess at what the debt is and how to represent it on the balance sheet. So let me get all the way down to the bottom here. This is a massive 10K. Okay, I think it's 145 here. So note 20 in the financial statements, debt and comments. So if you've never looked at a 10K before, it's typically business overview, big risk section, financials, and then notes. And notes are always on the bottom, and you'll see little footnotes in the financial sections, and you need to go to that note, typically note 5, note 10, in this case note 20 for debt, and it gives a much bigger, which is more detailed how they come up with the numbers. So definitely check out the notes section. Here, they do a nice job breaking out the debt between Ford Credit and Ford Automotive Group. Here you can see total automotive group debt. I hope you guys can see this. Let me zoom in. So total automotive, they just call automotive is Ford, and it's $14.68 billion. And then you go down right there, long-term debt payable. No, sorry. It's so close. Here, Ford Credit debt, $141 billion. So they're breaking out the two. They even classify it as secured and unsecured. So if you look at it right there, unsecured debt, they have $55 billion of unsecured debt. That's within Ford Credit. Ford Credit has lent out money to the dealerships for dealership improvement, to finance their automobiles, working capital, all kinds of stuff, but it's unsecured. It's just a promissory note to pay back. There's no actual cars backstopping you. You can't go out and say, give me this VIN number and have a tow truck company just literally pull the fleet away for your money. You have to go through the corporation. It's a much bigger problem. Asset-backed debt, this is much better. It's cleaner debt. In the note obligation, it will actually say, these VIN numbers are what I'm loaning against. So if they ever got in trouble, they could go to a repo man and say, hey, these cars are mine. Here's the court document. Here's the loan docs. Get these VINs, and they'll go take the cars right away. So this debt, $32 billion, is much easier for Ford to pull back, or some creditor to go get if they had to. The unsecured debt isn't, and the unsecured debt is a problem. So totaling it, what I did is I took down here, you can see auto short long-term debt. This is the auto being Ford Motor Company, is $15 billion, which isn't that much debt for a major corporation. That's fine. It's the Ford Credit debt that they put into an SPE. SPE is special purpose entity. It's a legally separate entity. The reason they do that is because it's isolated from a legal and accounting perspective. So banks can lend just to this entity because all the cars in theory are there, but they have cars plus other unsecured debt. It's a legal and accounting structure. It's used commonly, but it can be abused. Like in the case of Enron, not saying Ford's Enron, but in that case, it gets wildly out of control, and you start playing games between what numbers Ford is, the Enron was reporting and the SPEs were doing. Here, I don't think Ford's doing it. They're consolidating everything, but I still don't like it because when you read the 10K, it's very confusing. What is a liability, what is an asset, because they're lending between Ford and Ford Credit. So for this case, I've consolidated everything and just said, I don't care who it is, it's an obligation from the parent, the Ford company. And in the 10K, it does say because Ford owns the majority of Ford Credit, the accountants do consolidate the whole thing. But $141 billion of debt at Ford Credit. I add these two up. There also is a pension obligation of $19 billion. And I've kept this flat historically because I don't want to go through every single 10K and pull out the debt obligation. I did that for the debt. I did not do that for the pension because it's in the footnotes. It just takes a whole lot longer. The point is, it's there. It hasn't changed much, so it's in the numbers, and that's how I get $177 billion of debt for Ford, and I'm putting that in the enterprise value. Okay. Debt, $177 billion. Cash on hand, they do have cash. They have $13 billion of cash. Kudos for them for having a little jack on hand. Market cap, $36 billion. That is a very low market cap. That makes enterprise value $200 billion. $200 billion divided by our magic number over here of $11 billion is a market multiple of 18 times enterprise value to EBITDA, which is high for a company with no growth. It just is. I mean, if you look at some of the other companies that are trading out there, Tesla's a little crazy at this point. I think it was north of $2,500 a share before it split. I don't even know what the EBITDA multiple would at this point be. It's probably close to 100. But Ford's at 18. I think that's rich for a company that isn't growing. But it's not unreasonable. What I don't like, what I think is unreasonable, is the debt. So if you look at the debt, the far column over here, the debt is currently at 16 times EBITDA. So that means if something were to happen in the financial markets, if interest rates were to go up, or for some reason people simply stopped lending to Ford, they would have a real hard time because that debt is coming due. Every year they are refinancing something like $50 billion of debt. And if that were ever to change, they'd be in a hard-pressed situation to come up with enough cash to make those payments. And that is a big warning for us. Even if some of that is asset-backed and it does have collateral against it, there's a large check that does not, and that's one of the hallmarks that we're going to vote no on because it's too levered. All right, let's pause here. I'll show you, let's recap. So revenue, 2% growth, acceptable, but really not ideal. EBITDA is flat. We'd like to see it back, even if you add back the pension, even if you add back the one-time global infrastructure adjustment, it's still mildly flat. So I think that's a pass there. Enterprise, the valuation I think is rich for no growth, but it's not unreasonable in a market like this. And debt is far too high at 16 times debt. That's a non-starter for us. Let's look at cash flow now. Now, cash flow is a trick here. Let's actually go to the cash flow statement. Did I mark down the cash flow 99? Can I punch in here 99? So in the cash flow statement, one of the reasons companies create SPEs is to separate what's going on in the entity, the SPE, from what's going on in the parent. And you can see that clearly here in the cash flow statement. And it's an adjustment you have to make, otherwise you're going to get it wrong. So here is our standard cash flow statement that we've been going through every year. You got 2019 here, 18 and 17 across the top. And you've got your cash flow start with net income to operating cash flow. Remember, in this channel, we always pull operating cash flow. That's what we want for the CFO. And fine, it says $17 billion of free cash flow from operations in 2019. And you're like, wow, that's a lot of cash flow. That's great. But it's missing a piece. It's missing the receivables or the working capital piece from the SPE. It's because it's a separate entity, it's treated as an investing cash flow. And if you don't read down a little bit, you're gonna miss it. And you'll see two monster numbers in here, 55 billion outflow, 50 billion inflow. What is this? It says acquisition of financing receivables and operating leases. And then it says collection of financing and receivables and operating leases. This is the receivable. It is the loan that's made to a new customer who bought a Ford, that Ford Credit owns this receivable. You've leased your car from Ford Credit, you're making payments. That payment, as represented from Ford's perspective, is a receivable. And what's going on here is Ford Motor Company is reaching down into the SPE and say, I want to buy that from you at the parent, bring that back to the parent, and I'm going to pay you cash, Ford Motor Credit, for what you sold me. And it's an exchange. Every month they're probably doing it. But the point of it is because it's not the corporate enterprise of Ford Motor Company, it's a separate entity. It's treated as an investing cash flow and shows up in a different section. So what you need to do is you need to net these two. This is a -5, right? You go back prior year, this is a -12. You go prior year again, that is a -12, I think. Yes. And so if you don't take that negative, which is a cash burn, right? Because they're investing in, or rather, it's sales that were made, but you haven't received the payment on the sale yet. So it's a negative on cash. It's revenue was increased because you made a sale, but that revenue wasn't cash. So when it flows through to the cash flow statement, it's a minus because you didn't actually receive the hard currency. So what I've done to help bridge that for you is I have shown here, you've got the CFO as stated in the cash flow statement, $17 billion, $17 billion. And then this -5 is me netting these two lines. So the $55 billion of outflow and the $50 billion of inflow is a minus $5 billion. So I take the $17 billion that they said they made a cash flow from operation, and I normalize it as though you had taken, as though Ford Motor Credit was consolidated as part of the operating cash flow, and I get a $12 billion. Oh, sorry, my math earlier was wrong. It was actually 5, 12, and 14 negative. I think I said 5, 12, and 12, but it's 5 billion negative, 11 billion the previous year, 12 billion, and then 14.7 or close to 15 billion. And again, all that is, it's a timing issues because they made a sale. That sale didn't come in all in cash, so it's a reduction of what they're claiming as operating cash flow because they didn't receive all of it. So that's the adjustment. And then this is the true cash flow from operations. Cash flow from operations normalized. And you can see it's considerably less than what we had before. What we had before was, right, it was showing 3 years running 18, 15, 17.6. You normalize for the cash flow receivable that's in Ford Credit, and you get an entirely new number, which is significantly less than what you would think originally. Last thing I want to note, and then I'll get off this piece and we'll kind of move on. This $12 billion here, you think, whoa, 3,312, that's amazing. No, it's because sales dropped, and it's a trick within working capital. So this sale here that went from revenue went from $160 billion to $155 billion. That's a drop in revenue. And what happens is this $160 billion that was delayed last year is coming in as cash because they're payments, right? It's over time. So you've got this stream still kind of coming in as a receivable, which is the positive, and this stream, the 55, which is a negative because it wasn't received just yet. So the positive is greater than the negative, and so this number here goes up a little. It's a timing. The next year it will revert back down. So we can't rely on this 12 as just string it forward and grow. It's really more of an averaging of these years to get a feel for what the business is going to do. So that's cash flow from operations. CapEx, again, the cash that they have to put back into the dealerships, the normal, cash drain to keep up the business, keep the plants running, the robots working, the paint on the walls, the windows clean, like all that infrastructure is a lot of cash. And you can see in many years that cash is actually greater than the cash they generated from operations given my adjustment, which is a problem. So then how do you do that? How do you bridge if you generated $3 billion, let's say on average in this range here of cash flow from operations, you have to put back $7 billion. Oh, looks like you're borrowing money. Bingo. Positive debt payment, meaning cash coming in every single year. They are borrowing to keep this train running. That's a problem. It's a big problem. You saw it in the debt pay. If you see it in the leverage numbers at 16 times, they're using the fact that it's asset backed, that some of it is. Banks are lending on asset backed. Debt is cheap. The federal government pretty much owns the bond market at this point. So, they're able to get financing. They got great name, and they are, and it's reflected in their leverage. And so, free cash flow to equity is positive. Why? It's positive because they're borrowing. Now, I don't know if that's going to continue, but if they can't grow earnings, I can't see it continuing forever. At some point, that's going to tail off. Shares are growing slightly over the long period of time, and they're slowly issuing a little bit of shares. They're borrowing money to keep the cash flow in the door. And what I want to do quickly is note here on the cash flow, like where's this money going? They pay a strong dividend. So in 19, cash dividend out $2.4 billion of cash dividend. And just for funsies, I went back and I pulled the 2007 10K. Let's see if I can pull that up. Yeah, here you go. 2007 10K, before the economic meltdown of '08. I wanted to see what Ford looked like back then and see what decisions they've made then and now. And well, first of all, revenue, I think they were slightly bigger, so they've come down in revenue. Assets, cash flow, where's the income statement? I had a plan here. I guess I'll just stick with cash flow. Give me 1 second. Income statement. Here, automobile sales. Yeah, so 27 automobile sales, $154 billion. Last year, right? Last year, 155 billion. So 13 years ago, their sales were roughly what it is now. Okay, that's definitely no growth. The point of hit I wanted to show you is back then in '07. I'm back on the '07 10K. If I go to the cash flow statement, which I'm on page, let me get to it, 108 on the cash flow statement, you can see 2007 10K come down. So again, business is roughly flat. They're doing the same revenue they did back then that they do now, but look at the dividend that they paid out back then. Dividend. Well, here it's zero. They paid no dividend in 27. Prior to that, they paid $468 million. Now they're paying $2.7 billion. What? Revenue's flat. Why are they paying out 5 times the dividend when they have to be reinvesting for electrification? They've got a ton of debt. Like, this doesn't make any sense. And when I look at these numbers, I think it's a travesty that you got a fantastic brand name of a company that received a bailout package at '08 as part of like the too big to fail nonsense. And what do? They boost the dividend, pay out a dividend for 10 years, forget to reinvest in the business, and now they're scrambling behind Tesla and all the EV startups that are gonna, frankly, eat their lunch. And so it's sad to see management take a track where they're trying to appease the near-term shareholder at the expense of the long-term enterprise. Let's go back to the numbers. Okay, so now I'm on cash flow. What do you want to do? How do you want to forecast a business that needs to evolve into a changing industry? It currently has no growth. It has high debt. What am I supposed to do with this? Just guess? You know, that's essentially what you're doing here. You're just throwing a dart in the board and saying whatever. But that's not what we do here. If I can't underwrite the growth, I'm not buying into it. So what I'm going to do is I'm going to say, let's pick up EBITDA here. EBITDA, $11 billion. There's a little bit of add backs there. Fine. I'm going to give it 2% growth, mainly because Fed's increasing the money press for inflation. So at a minimum, they're going to have nominal growth of 2%, which is zero in real terms, and they're essentially flat. They've got a 14.5 average EV/EBITDA multiple over this time frame. I'll give them the same multiple, 14, call it 15 times, whatever. Less debt, which is still monstrous, by the way, plus cash gives me $53 billion market cap. They're at 30-something billion now. Outstanding shares, that's a $13 share price that they could hit someplace between now and 10 years from now if they get their act together. Cash flow is kind of the same thing, 48 cents. Where am I getting the 48 cents? I'm averaging, I think I averaged these areas here. But again, this 2019 was artificially high due to the timing of the receivables, so I excluded it. I said, look, they're gonna average cash flow 48 cents, it's gonna grow at 2%. But in reality, right, they're paying a dividend that's too high. They gotta cut that back. They have to invest in the mobility sector. They need more than $1 billion a year to catch up to everything that's going on. The trailers I've seen on YouTube for the electric truck towing the rail cars is a joke. The coefficient of friction for rail cars is, I think, 10% that of cars on the road. And it's I think there's about 1,200 pounds of what they're pulling, which is mediocre at best for a pickup truck. So that's unimpressive, and there's very little stats on it. I'm not going to hang my hat on their electric car now when everything else is taken off. and I really want to see them improve their balance sheet to grow long term. So the long and the short of it is, I've got a $7 price in the market currently, roughly. I've got two different metrics, both pointing around, one's cash flow is $11.25. If I do the EBITDA method, I get $13.45. Average $12.35. Call it 12 bucks, whatever you want, just split the difference. Throw it into the handy-dandy IRR calculation, right? So I've got the stream of cash flow here, which again isn't all dividendable. This is just if you had the cash flow as an owner, you own the business. Cash out $7 for the purchase of the share. You get a stream of cash flow every time you exit it at, call it 13 total. That's a 14% annualized IRR. Again, that's 14% annualized compound every year for 10 years, which is above market. But who has confidence in the forecast? When I look at the street, some people are having negative earnings. They're definitely negative down this year. This EBITDA of $11 billion in 2020 isn't going to happen. So you're thinking long term, they're going to claw their way back to $14 billion? Maybe, maybe not. But they have to offset all the customers that are going to buy their electric cars and electric trucks. They're going to offset that with losses that from people who would have bought a gasoline truck and are just buying electric. So it's not incremental sales, it's not growth, it's cannibalization. So I think Ford's in a tough spot, and that's not something this channel we're willing to bet on. I'll give you the standard distribution curve, right? So but behind me, this is just numbers. It's me taking numbers, stringing forward. You need to smell check it. Does it make sense? Are you willing to roll the risk that Ford Motor Company can evolve and turn itself around? I think it's a big guess. But you can see if the share price were to pull back into the $5, $4 range, maybe that's worth it. Staring at 20+% IRR for a decade is a really strong number, and I think at that range it might substantiate the investment and the risk of buying in the Ford company. But right now, I'm going to give it an ugly. I think there are way better companies out there in the market that have less debt, higher growth, better prospects for future, and frankly, a forecast that's a bit easier to get my arms around. Here, it's a lot of guesswork, and what we're doing is, if you've got, say, 2,500, 3,000 stocks in the universe to buy, you only have so much capital, maybe hold 10, 20, 30 stocks in total portfolio. Okay, so you need to be really judicious and screen out things that don't hit everything right on the nail on the head. And this has a lot of holes in it. Again, top line revenue growth wasn't there. We looked all the way back at 2007. They're flat. Earnings are flat. High debt level. Cash flow is weak, if not negative, but for the borrowing. And the well price, it's still expensive. So we're an ugly, we're a pass at this channel. But we're going to keep hunting through, keep finding new stocks, and tell you what I think. My name is Cameron Stewart. This has been Rational Investing. Thank you for watching it. Subscribe, comment. I'd love to hear the recommendations. Trying to get through all the comments. It's a lot of fun. Let me know what you think, and have a great day. Bye-bye.